Now, the big thing that drove markets lower on Tuesday was the CPI, which is the Consumer Price Index. And it basically was a little bit higher than expected, but the big thing is that it caused investors to say, wait, the Fed is not anywhere close to backing off of its interest rate hike campaign. And in fact, we could get much more in terms of interest rate hikes that could put the brakes on the economy, put the brakes on the market, and drive us into recession. This is a little bit of a frustrating period because I see a couple things going on here. Yes, inflation is high, but there are some signs that inflation is starting to back off. Meanwhile, these key headline numbers that the Fed is going to be looking at very carefully are extremely hot. So here's what I see happening, and it's a little bit scary, but it's another reason why we need to have wealth preservation and the defense on the field. I see inflation actually starting to back off. We've seen some real key data, that the high frequency data that tells us what's going on right now, showing that new rentals, and this is residential rentals, are coming down. So the price that you have to pay to rent a house right now is starting to come down. And that's a really important piece because that is a big part of what is driving inflation higher. However, think about this for a second. If you make a new rental agreement right now, your rent might be lower because a landlord has a vacancy and they now realize that the market has changed. But everybody else who's already got their rentals, they're still paying the very high price, the inflated price, because rents were much higher 2 months ago, 3 months ago, 6 months ago. So even though the newest rental lease that are signed right now are lower, that's not showing up in the CPI report, where it's a very, very small piece of the overall rent picture. And so the CPI, it's very much a lagging indicator. It's still directing the Fed as to what they're going to be doing, but it's not showing the fact that rents are actually starting to come down, especially in some of the frothiest, high level markets. So here's what I expect to happen. The Fed is going to continue to be aggressive. They're going to continue to hike interest rates. And that's going to cause the economy to go into a deeper recession. Meanwhile, inflation is already pulling back. So we're already starting to see the effects of previous rate cuts and just the fact that people are starting to kind of come back to normal. So what happens if inflation is already moving down? The Fed is still hiking rates. And keep in mind, when the Fed hikes interest rates, it takes 6 to 9 months for those interest rate hikes to actually hit the economy. So if the economy is already moving down, the Fed's hiking rates, and 6 to 9 months, those rate hikes are going to affect the economy, it means that you're kicking the patient while he's already down. And it could be, pretty bad news for us for quite some time. We might wake up in, March or April of next year and say, oh crap, the Fed has really hiked rates way too far. We're in, a deep economic slump, and then the Fed has to start cutting rates. And so that's what I'm looking at for the overall economy. Another just important piece to think about for the economy is that wages are starting to moderate quite a bit. And that was another area that was a big push for inflation. So wages are coming down because more people are coming back into the market. More people are getting hit by this inflation and saying, hey, I got to work. I can't just sit here and spend my savings for years and years and years to come. So as more people come back into the workforce, companies don't have to compete so hard to pay a signing bonus and a much higher salary or much higher wages to get these people in the door. They've actually now got workers that are knocking on their doors saying, hey, I'm looking for a job. Are you hiring? So as that comes in, it will help with inflation, but it will also cause problems for the overall economy if the Fed continues to hike interest rates. So we're at a really interesting crux right now with the economy rolling over, the Fed continuing to hike interest rates. And that sounds bad, and it has been bad, and that's really why we're seeing the market trading lower. However, remember, the market is a forward-looking mechanism. So the market is already telling us that the bad news is priced in, or that the bad news is coming. So when things get really bad, that's when we're actually going to start seeing the market moving higher, because it will say, okay, we're at the lows, things are bad, but we've got better times ahead once the Fed starts cutting interest rates. And that can be confusing, but the point is that we always want to stay ahead of the game when it comes to our investments. So we want to make sure that we're investing in the areas that make the most sense for the environment that we're in right now, paying attention to what's coming ahead, not just what's in the rearview mirror.